Hi everyone, it's Mike from Order Flows and welcome to the Order Flow Dynamics course, Module 2, Market Internals. Now, the thing that most traders seem to be focused on is price, right? And there's a problem with only looking at price. Price moves in relation to itself. Prices move to measure change, and as a result, it's one-dimensional. Price changes are thought to be the cause of market conditions, but price movements are the result of market condition. Now, price movement in relation to itself has no meaning, right? Price always changes. That's why it's difficult to interpret. So focus instead on market conditions, because it's the change in market conditions which cause the changes in price. Now, again, I can't stress this enough. Being focused solely on price is a problem, right? Price can move based on external factors, that have nothing to do with where price is trading at right now. If you're not familiar with what Delta One desks are, they're desks that trade futures. They don't really care where the futures are trading because they're trading all these other products and they're just laying off risk in the futures contracts. So as a trader, you don't know what other traders are dealing against, but if you focus on the internals of the market, you can better trade because you know what's happening in the market. So for example, right, this is the Bunds and we're making new highs. And anytime you're making new highs, the market's bullish, right? But if you're looking at the market internals, you can see they're quite bearish, right? You can see here at the high, just after just around 4:30, right here at the high, you can see what the min delta is doing. It's very strong right at the high and immediately after the high, even in the bar right before the high. Now I'm going to explain a little bit later in this module how to understand the max delta and the min delta. But by looking at the internals of the delta, you can understand when the market is bearish, when the market is bullish. Now, another common misconception is volume, right? And what it is, people say, well, volume that's unusually heavy is bullish. Well, when a market has been trending down, it can be. But what about when the market's at a high and there's unusually heavy volume? It's often a sign that the top is forming in the market. So for example, here we're at their highs and we're making these highs and we're doing it on strong volume. Most technical analysts will say we're making these highs on strong volume, the market should go higher. But what happens is the market turns around and starts selling off. That's not bullish, right? Often what's happening, it could be a combination of things. Most often it's FOMO, right? Fear of missing out. Everyone's rushing in. Oh my gosh, we're making new highs. I gotta get long. I gotta take advantage of this. And what happens? Eventually, the market starts selling off rather quickly. It's another example, right? We just pop right up to this high. We just push right up to the high. The volume is 10 times what it was in the previous bar. And, even the bar before it and the bar before it, it's 5 times as high, right? We push up to these new highs, no follow through, market starts selling off and starts selling off pretty quickly. It retraces a full 10 points in the S&Ps pretty quick. Now, when we're coming down into the lows, you might want to look at it a little bit differently, right? Because what's happening is people are coming in and saying, hey, this is a good buying opportunity. Maybe I could buy it. But again, sometimes you see the heavy volume. What happens immediately afterwards? Nothing. Market goes sideways. But if you're looking at the market internals, it's going to give you a clue of, whether the market is getting ready to pop higher or just go sideways. Here we are. We spike down and go back up, a nice V pattern, right? And if you're just looking at the volume, right, we're at the heaviest volume at the low of the day. 14,000 contracts traded. Prior to that, it was only 11,000, 11,000, 9,000, 8,000, 6,000, 6,000, 4,000. Heaviest volume, right? Yeah, is it bullish? Well, yeah, we're at our low of the day. But I showed you, you're at your high of the day and you got heavy volume and it was actually bearish. Now, if you're looking at the market internals, right, max delta, min delta, which I'll explain later, you can see how it's getting stronger, coming down into the lows. It's just 16, which is nothing. Max delta is 120, 371, 1,000, right? And then boom, market takes off and rallies a quick 10 or 15 points right after that. But again, don't fall into this one-size-fits-all thing about volume, right? Understand, take it in context of the market. Heavy volume at a high could be a sign of a market topping. Heavy volume at a low could be bullish. that, buyers are attracted to these low prices. Again, it's not one size fits all, and it's not the same thing. You got to be looking at what's happening in the order flow. Now, if a move is strong, it will most likely strengthen with solid volume behind it. And when there are large volume swings in a bar, something is afoot. And what do I mean by volume swings? Okay, what I'm talking about is when it goes from max delta to min delta, depending on where we are. Like here we are at the low of the day. Okay, we've got very strong min delta. It's minus 886. Max delta is 371. Final delta closes at 268. So you got this swing, right? You're very strong negative delta, right? Minus 800. But it closes at 268. So it went from minus 800 to positive 268. That's a swing of 1,000 contracts. That's what I talk about when you got a large volume swing internally in the bar. And you can only notice that it's happening with the max delta, the min delta, right? The market internals. Now, on moves down, right, you see heavy volume on the bid side of red bars. You want the bar to close below the heavy volume bid size, just as, on an up bar on the offer side, the heavy volume is going to be on the offer side. You want to close above it. So, for example, it's a 5-minute E-mini bar, right? Heavy volume being traded on the bid side. You can see, relative, just look at some of these volumes. At some of these levels, 1500 versus 1500, 2700 versus 137, 339 versus 195, 297 versus 193, 525 versus 264, 600 versus 500. Where are we closing? We're closing right on the low. We're getting through all this volume, just chewing right through it and closing down at the bottom, right? You want the bar to close below the heavy volume on a down bar, or on an up bar. You want it to close above the heavy volume, right? You see the heavy volume was down here on this green bar, 1600, 1400, 800. We're closing all the way above there. Now, heavy volume into new high ground is an effort on the market's part to go higher, but there must be follow through in the order flow, right? You need to see aggressive buying in the new highs, right? Otherwise, the market's not gonna go anywhere, right? When you start to see passive selling, big offers at the high, the market could be topping out. So, for example, right, if you're looking at a normal bar chart, you can't see what the volume is, right? Maybe you had the volume indicator down here at the bottom. You can say, well, yeah, I can just see the volume. But really what you want to do is you want to understand what's happening inside the bar, right? This is that high that was made here on the bar chart right here, right around 1240. Just before 1240. Well, this is a 5-minute chart. This is a 1-minute chart. But you can see, right? You can see there's heavy volume on the offer. Here's 1024 versus only 231. Here's 776 versus 568. And you're not seeing that follow through buying, right? The market went up, came right back down, closed below all this heavy volume on the offer side. Right, then we start trading lower. I mean, look at the offers on the top of these bars. 190 versus 85, right? 60 versus 4 here. 165 versus 22, 464 versus 326. 212 versus 144, etc. There's heavy volumes up here at the top, stopping these moves from going back up. Right, that's important. Right, for the market to go higher, it needs to take out those volumes. The buying's not there. It could be a combination of not buying as well as people offering out in here. So understanding excessive volume. Now, volume is made up of both buying and selling, obviously, right? But when you're at a high and you see excessive volume, it's easy to get excited, think the market's going higher. But what's happening is supply is coming into the market. Okay, you have to look to the left. Is the high fresh territory, or is it an area we spent some time in before? Fresh territory with heavy volume is good, but an area we've been in before with heavy volume and the market struggling to go higher, signal supply coming in to potentially halt the move higher. So, there's a saying, look left. And, if this is an area that we just traded at and you're seeing heavy offers coming into the market, that's not a good thing, right? Because people realize, the market is getting expensive, and they're happy to sell their supply at those levels. Now, weak buyers and sellers, right? Most of the time we're focused on where the majority of volume trades, right? But we have to start training ourselves to look at areas where thin counter trade occurred, as this often clues us to areas where weakness is taking place. For example, a market makes new highs, but instead of continued buying, there's weaker buying on the offer as the market hangs around the high. So for example, okay, this is weak sellers in preceding a move up. So sellers have realized they can't sustain the move down, right? They can't make money, right? When you think of a weak seller, someone's thinking, well, I got to sell. I think the market's going lower. And what happens? The market turns around and starts going higher. So if you look at the green bar up, right, look what's trading on the bid side. There's very little counter trade in here. There's 8, there's 2, 33, 1, 47, 65, 29, 41, 1, 4, 19. That's pathetic. That's nothing, right? Where is the sellers, right? They're no longer there. You know, on the way down, you know, they're selling 180, 175, 226, 267, 123, etc., all on the way down. But, you know, as the market starts ticking higher, you know, if you sold down here at 30.85 and next thing you know we're trading at 87, you probably want to sell more. But those sellers are no longer there. They're starting to realize that they're wrong, and they're covering it, right? They're covering. That's what often you see, how a market snaps back with immediate buying imbalances right off the low. Yeah, same thing when you're at a high. You know, look at the counter trade. You hit the high, okay, that's great. You know, hey, maybe this market's going higher. But then we start coming down. Where is the buyers? Remember, you're buying 400, 400, 400, 400, 190, 130. Look at this. On the way down, where's the buyers? 68, 0 at this level, 38, 97, 99, 0, 16, 50. You know, those buyers are no longer there, right? It's just, they're just not there. And what's happening? People that were buying it up in here, thinking we're going higher, shit, you know, we're not going higher. I got to start selling. They're selling this on the way down. So I see these selling imbalances. Very thin volume on the offer side on the way down. There's no counter trade. Now, unfair highs and lows are where volume comes out of the market. Okay, what this means is at an unfair high, buyers start thinking they can't make any money on a move higher, so they stop buying. Right? Sellers start coming in. At an unfair low, it's the opposite, right? Sellers realize they can't make any more money selling the market lower because they think the market isn't going to go any lower. There's not a lot of activity and not a lot of volume, right? That's what you're seeing in here, right? The weak buyers on the move down. There's people that were buying it here realize, you know, we're not going higher. They're not buying it anymore, right? And oftentimes they're turning sellers in there. So now when selling decreases on moves down, right, selling pressure is no longer present, right? The market has the tendency to rally. So this is the path of least resistance. So selling pressure needs to be strong and consistent to keep the market moving down, right? Markets always look for the path of least resistance. In up moves, for the move to continue, there needs to be consistent buying present. Demand needs to be present. And what do I mean is, on moves down, like we saw earlier, right? Moves down, we start ticking up. Where's your strong selling coming in, right? You still need to have that strong selling. It's no longer there. 2, 8, 1, 33, 47. You want your selling 100. You know, if this is all the, you know, if this was what the bids are, you know, say 10 lots, that could easily be sold to move the market lower, but it's not happening anymore, right? These people that were selling it are realizing, you know, this market ain't going any lower. They got to start covering it before it gets out of hand and starts getting away from them. Now, weakness in an up bar, as the market is making highs and the bar does not close near the bar's high and instead closes, you know, below the midpoint, you know, that could be bearish. You know, it warrants further investigation into the volume. How is the volume in the bar and the overall bid and offer? So weakness in a down bar is the opposite. It's, you know, as the market is making lows and the bar does not close near the bar's low, instead, you know, it closes somewhere above the midpoint, it could be bullish, right? It warrants further investigation into the volume as well. So for example, weakness in down bars, right? We're probing lower, come back up, probe lower, You know, it's kind of there. Next bars we probe down, come back up, probe down, come right back up, go down, come back up. You know, these are the wicks, all right, for people that are into candlesticks. Why aren't we closing near the lows? All right, we got down bars, but it's not quite weak enough to close down there. You know, there's buying coming into the market, close it a little bit higher. Now, if you're looking at the market internals, yeah, I mean, it looks bearish, but then, you know, it looks bearish. You know, we're looking at these things, very strong negative deltas. We're closing right near our negative deltas, but the bars are closing pretty much unchanged, right? Something is afoot. You got to be alert to what's happening there, right? You got the strong negative deltas, you know, minus 1,000, minus 900, minus 700, very little max deltas, 10, 0, 26. Yet the market is closing pretty much unchanged. You know, that's not a good sign for a market that you're looking to go lower, right? You should be looking for a sign, you know, the what do you want to call it, the tripwire, that the market is going to be going in the other direction, and you get it right here. Boom, we start closing higher, right? Higher point of control than what you had earlier, closing up near our highs of the bar. Obviously, our max delta, min delta internals are very bullish as well. Okay, so now let's take it a step further beyond the simple volume. Let's look at the order flow max delta and min delta, right? I was telling you that max delta and min delta are very revealing into what the market is going to do. So delta is the net difference between aggressive buyers and aggressive sellers in a bar. You know, it's the headline number, so to speak. However, there are two other delta numbers a trader can look at and use in their analysis, the max delta and min delta. Max delta is the strongest aggressive buying was at one point in a bar. Min delta is the strongest aggressive selling was at one point in a bar. Think of it like this, right? In most sports, they have what they call slop time, right? In basketball, you know, it's the third, imagine it's the third quarter, you're up by 32 points. So the coach decides, you know, take out the stars, let them rest, and send in the second team to get some playing time. But you only end up winning by 6 points, right? The game was never in doubt, but the final score, the difference was only 6 points. So people will look at the headline number and think it was actually a close game because they just see, well, oh, we only won by 6. Well, yeah, but you know, earlier we were up by 32, you know, and we took out all our stars. So in reality, it was never close. And you know, that's where max delta and min delta come in, right? Now there's two ways to look at max delta and min delta. You can look at it numerically, or you can look at it visually. Now, numerically is you're just looking at the numbers themselves, the raw numbers. Then usually they'll appear along the bottom in the bar. And visually, you can see them along the bottom in candlestick form. So, for example, numerically, right, on a footprint chart, you can see them down here, max delta, min delta. The top number is delta, then max delta, min delta. So you can see, right, max delta will never be negative, min delta will never be positive. The most negative, I guess, max delta could go is 0. I wouldn't say most negative, but the lowest it can go is 0. Min delta, the highest it can go is 0. It'll never be positive. And, you know, from looking at that, you can see, you know, where, you know, certain bars never had any max delta at all, or some bars had no min delta or very small, -1. Right? You can see you're stringing together some bars, it's just all min delta. There's no max delta, right? You're coming along right at your high. Lift out the A there. Delta, max delta is 0, 0, 3, 17. It's all min delta, -22, -32, -75. Right up here at your high of the day. Where's your buying? There's very little aggressive buying going on up here and here that's turning the delta positive. All right, no max delta in any of these bars. Here you got 3, and the market sells off. You know, a quick $3 or $4 here. That's in gold, right? Numerically, delta. What do we got here? Again, you're right up here near your high of the day, right? You want to be seeing, you know, for expecting the market to go higher, you're expecting to see strong max deltas, right? And first time you get up to the highs, yeah, you see 900, 310, 388, 412. Then 101, 114, 97, 41. You know, that's not a sign of a healthy market that's looking to go higher. Now, if you want to see it visually, right, you could have a tool. You know, there's a lot of tools on the market. I have the delta candles, but you can see each candle, right? So you can see like here at this low here at 1116, you can see the red candle, right? It signifies the delta was 1. You can't see the small little wick on the upside, but min delta was minus 521. That's the wick to the downside. Final delta was minus 296, so it was minus 296 here, right? The next bar, final delta was 485, which is the close of the bar. Max delta 599, that's that little wick. Min delta is this little tiny wick down here on the bottom, right? So for some people that are more visual, it's a better tool to look at the max delta and min delta, right? You can see these areas where, you know, right down here at the low, where you got your low of the day, very strong min delta, minus 1178. We closed at minus 812. We had a very small positive delta, right? Then the next bar, very little min delta and all max delta for the most part. We closed at 1009 in the final delta. Max delta was 1074, right? Then you can see these areas where you got these dojis, so to speak, delta, right? Minus 6. You can see it's just small little red candle here. Minus 496. So at one point, the max delta was quite strong. Final delta closed at 34. So you know that at one point there was some strong selling in this bar. Max delta was only 34, but min delta was minus 496. So early, you know, at some point, maybe as this bar was starting to sell off, there was strong delta that was bearish, but it turned around and we closed up. The bar closed higher and final delta just settled at minus 6. You know, here's another example, right? Here we got this big push down, right? It's very bearish. Oh my gosh, I got a big stack selling and balance. I gotta get short. But if you're looking at the internals, yeah, we push very strong down, but some buying came back in, right? You can see that max delta was only 10. However, final delta was minus 181. You got this big wick. You went from minus 1095 to only minus 181. So while you were looking at a big red candle down, it only closed at, you know, kind of a small down red candle. Okay, so that's telling you already that, hey, you know what, we had some strong selling, but buyers came in. And if you look at the volume in here, take it a step further, analyze what you're looking at, you see, well, there's 1,200 on the offer there. They bought it, right? That's why you have went from minus 1095 to minus 181. This is 1202 on the offer that buyers were buying in here, right? Someone was trying to offer it out here, offering supply, but you know, at this level, people were happy to buy it, and you can see market went back up, right? It got through this level and started trading higher. People were happy to buy whatever was being offered down here. Okay, here's another example, visual delta in the candles, how you can use it to your advantage. Again, you just see these bars, right? You know, anytime you see a green candle with red delta, right, an up candle with negative delta, it's telling you there was probably some supportive buying in here, right? You can see the imbalance 29 against 7. You can see the bid side 25 against 13, 28 against 11. That's why early on in this bar, it was a nice strong negative delta, minus 63. Closed at only minus 21 because these buyers were absorbing the selling that was coming in here. And then the next bar, nice strong positive delta. Next bar, kind of mixed. You know, it's nothing. It's minus 13, positive 8. Final delta 6. But then the next bar, look at the delta's expanding. 78, right? Minus 8 on the min delta. Max delta 85, right? So what's going on here? If you're noticing the selling going on in the min delta, went from minus 63 to only minus 15 to minus 13 to minus 8. You got the stack buying imbalance. It's time to get long, right? Because you know that there's buying in here, the supportive buying. So, you know, if you're getting long here, you just got to stop right in this area. But then what happens? Boom, this is where it takes off. $18 all the way up to 1802, 1802 and a half. You can just see it's all buying. 122 in this next bar. This is the bar. But you could have been clued in this bar by seeing what's happening in the min delta getting weaker till it gets to the point of 0. And you know, here's another example. Again, this is gold. This is a 1,000 tick chart, right? I mean, notice what's happening here, especially in the min delta, right? We're selling off, right? We're selling off. You know, I'll be honest. You know, when market's selling off, everybody is looking to get short. However, if your market is selling off, but you're noticing the min delta, the strongest selling has been in these bars as you're going lower, 215, minus 158, minus 119. Okay, these three bars is telling you the selling is weakening till you get in here on the bar on the low, minus 55, and it closes at minus 6. This is a lot more clearer than looking at these headline numbers, minus 177, minus 84, minus 85, then 6. You can see here how strong it was in the bars, minus 215, minus 158, minus 119. It's gotten much weaker. It's almost been cut in half as you come down into the low. Then as you hit your low, it's half of what the previous bar was. It's sort of like a half-life. Then the buying steps in, and again, you're getting long in here. Before this bar, as it's starting up, 1809, you up to 1814. It's in gold. It's a $5 move at 3 in the morning. I mean, it doesn't get any easier than that. You can almost draw a trend line here like this on the min deltas, right? And if you're looking at, the opposite, if you're looking at the max deltas, as you're going into the highs, it'll give you the same clues. So, this concludes module number 2. In module 3, we're going to discuss cumulative delta. So I'll see you on module 3.